Today, we're diving into Lesson 22, which focuses on capital budgeting and cost analysis. This is all about how companies make important long-term investment decisions that influence their future growth. We'll explore how businesses evaluate projects that require spending on capital assets over multiple years. The key tools they use include analyzing cash flows, calculating return measures, and applying strategic decision criteria. Understanding these concepts is crucial because these decisions shape the financial health and direction of a company for years to come. Today, we're focusing on Lesson 22, which is all about capital budgeting. So, what exactly is capital budgeting? Essentially, it's the process companies use to evaluate long-term investment decisions. These are investments in assets that will be useful for many years, not just short-term expenses. The goal here is to choose projects or assets that will help the company generate future revenues and support its strategic growth. It's a critical part of financial planning because the right decisions can significantly impact the company's success over time. We'll also touch on how capital budgeting ties in closely with cost analysis, helping businesses make informed and financially sound choices. Now, let's dive into the 5 essential stages of capital budgeting. The first stage is identification. This is where we spot an investment opportunity that aligns with our business goals. Next comes development, where we define the scope of the project, estimate the costs involved, and determine the potential benefits. Then, we move into selection. At this point, we evaluate different alternatives carefully and choose the best option based on analysis. The fourth stage is financing, where we secure the necessary funds to support the project. Finally, we reach implementation, where the project is executed, continuously monitored, and reviewed to ensure it meets its objectives. Understanding these stages is crucial for making informed investment decisions and managing resources effectively. Lesson 22 focuses on the first stage of project development, identification and development. This is where project opportunities are initially recognized and shaped. Managers play a crucial role here by generating ideas that align with the overall strategy and starting to transform promising concepts into clear investment proposals. During this stage, it's important to spot needs, problems, or potential growth opportunities that a project could address. Early alternatives regarding the assets required, timing, and project scope are also developed. The goal is to frame the proposal clearly enough so it can undergo a more detailed and deeper analysis later on. Capital budgeting and cost analysis begin here as well, helping to evaluate the feasibility and financial viability of the proposed project at an early stage. This sets the foundation for informed decision-making moving forward. Now let's focus on lesson number 22, which covers stage 2, information gathering in the capital budgeting and cost analysis process. Before managers can begin evaluating a project, they need to gather a complete picture of the project. This includes several critical pieces of information. First, the capital investment amount required upfront. Knowing how much money needs to be invested initially is essential. Second, the project timeline over its useful life, which helps in understanding the duration and phases of the investment. Third, the expected cash flows, both inflows and outflows, over time, which are vital for assessing profitability and return. Lastly, managers must identify risk factors and key assumptions that could impact the project's success. Collecting this information thoroughly enables a more accurate and informed evaluation moving forward. Now, let's focus on lesson 22, which covers stage 3, selection and evaluation. At this stage, projects only move forward if they meet several critical criteria: expected returns, capital limits, and alignment with the company's strategy. First, we apply financial tests by estimating future cash inflows and outflows. Then, we use tools like net present value, internal rate of return, payback period, discounted payback, and average accounting rate of return to evaluate the project's financial viability. Next, we rank projects by comparing alternatives based on value creation, risk, when cash flows occur, and the resources they demand. This helps us prioritize the most promising opportunities. Capital rationing comes into play when funding is limited. Managers must then select a combination of projects that collectively deliver the highest overall return. Finally, beyond just numbers, we have to ensure strategic fit. A project must support the company's long-term goals, not just pass financial tests in isolation. This balance between financial metrics and strategic alignment is key to making sound capital budgeting decisions. Now, let's focus on Lesson 22, which covers stages 4 and 5 of the capital budgeting process. Stage 4 is all about financing. Here, managers decide the best way to fund the project by carefully comparing different financing options. They evaluate each option against the project's expected cash flows, the level of risk involved, and the required rate of return to ensure the financing aligns with the project's financial goals. Then we move to Stage 5, implementation. Once the project receives approval, the investment is put into action. This stage involves executing the project plan, continuously monitoring progress, and later reviewing the outcomes to see if they match what was originally projected in the capital budgeting estimates. This review is crucial because it helps managers learn from past decisions and improve future capital budgeting processes. Together, these stages form a critical phase of capital budgeting and cost analysis, ensuring that investments are not only well planned but also effectively managed and evaluated. In this lesson, we focus on discounted cash flow methods, which are considered the gold standard in valuation. The key idea here is that money today is more valuable than the same amount of money in the future. This means when making capital budgeting decisions, we need to evaluate investment outflows against future cash inflows by converting those future amounts into their present value. This approach ensures that we properly account for the time value of money, making our investment decisions more accurate and reliable. Understanding this concept is fundamental to effective cost analysis and capital budgeting. Now, let's focus on Lesson 22, which covers the net present value, or NPV, method. NPV is calculated by taking the present value of all expected future cash inflows from the project and subtracting the initial investment required to start it. Essentially, NPV tells managers how much value a project adds to the firm by discounting future cash flows back to today's dollars and comparing them to the initial cost. The key decision rule here is straightforward: if the NPV is greater than 0, the project should be accepted. This is because a positive NPV indicates that the project's returns exceed the required rate of return, ultimately increasing shareholder value. So, NPV helps ensure that capital is allocated to investment opportunities that are expected to generate value for the company. When evaluating a project using the NPV method, the decision rule is straightforward: accept the project if the net present value is greater than 0, and reject it if the NPV is less than 0. Let's look at an example to illustrate this. Suppose we have an initial investment of $100,000. The project generates annual cash inflows of $30,000 over 5 years, and the discount rate is 10%. Examining the cash flow timeline, at year 0, we have the initial outflow of $100,000. From year 1 to year 5, each year brings in $30,000. To calculate the NPV, we discount these inflows at the 10% rate. The present value of these cash inflows sums to approximately $113,724. Subtracting the initial investment leaves us with a positive NPV of $13,724. Since the NPV is positive, greater than 0, we accept the project because it adds value beyond the required 10% return. This demonstrates the power of NPV in guiding capital budgeting decisions and ensuring investments contribute positively to firm value. Now, let's talk about Lesson 22, which focuses on the internal rate of return, or IRR method. The IRR is essentially the discount rate that makes the net present value of a project equal to 0. In other words, it's the rate at which the present value of the cash inflows exactly offsets the initial investment. Mathematically, we solve for the IRR by setting the net present value equation to 0. 0 equals negative initial investment plus the sum of each cash flow divided by 1 plus the IRR raised to the power of the time period. When it comes to making decisions, the rule is straightforward. If the IRR is greater than the required rate of return, we accept the project. This means the project is expected to generate returns higher than the minimum threshold, making it a worthwhile investment. This concept is fundamental in capital budgeting and cost analysis, helping businesses evaluate the profitability of their potential projects. Here, we're looking at the differences between IRR and NPV, especially when they give conflicting signals. NPV tends to be more reliable when the projects are mutually exclusive, meaning you can only choose one, and when the size of investments varies greatly or the timing of cash flows is uneven. This is because NPV focuses on maximizing the overall value of the firm. On the other hand, IRR can be very useful when managers need a more intuitive rate of return metric. It's especially handy for projects that are independent, where the decision is simply whether to accept or reject, and when comparing returns to a predefined hurdle rate. IRR works best when cash flows follow the conventional pattern of an initial outflow followed by inflows. The key conflict arises because NPV and IRR can rank mutually exclusive projects differently due to scale and timing differences. In such cases, NPV is generally the better guide because it directly measures the total value created, which aligns with the ultimate financial goal of the firm. Now, let's talk about the payback method, which is an important tool in capital budgeting. Essentially, this method measures how long it takes for a project's cash inflows to recover the initial investment. To calculate the payback period, you divide the initial investment by the average annual cash flow generated by the project. The result tells you the number of years it will take to get your investment back. The decision rule here is straightforward. If the payback period is shorter than the maximum acceptable cutoff period set by management, the project is considered acceptable. However, it's important to keep in mind the main limitations of this method. It ignores the time value of money, meaning it doesn't take into account that money received today is worth more than money received in the future. Additionally, it disregards any cash flows that occur after the payback period, which could mean potentially profitable returns are overlooked. Despite these limitations, the payback method remains a quick and simple way to assess the risk and liquidity of a project before making further, more detailed financial analyses. Now, let's talk about the payback methods. The standard payback method calculates the time it takes to recover the initial investment by simply adding up the total cash inflows. However, it treats all dollars the same, regardless of when they're received. On the other hand, the discounted payback method improves on this by using the present value of cash inflows. This means it accounts for the time value of money, discounting future cash flows at the required rate of return. Essentially, it measures how long it takes to recover the investment in today's dollars, recognizing that money received sooner is more valuable than money received later. This makes the discounted payback method a more accurate tool in capital budgeting and cost analysis decisions. Now, let's talk about the accrual accounting rate of return, or ARR. This is a useful measure in evaluating investment projects. The core formula for ARR is the average annual operating income divided by the average book value of the investment. To calculate it, we first need to determine the average annual operating income, which is based on accounting profits over the life of the project. This gives us a clear picture of the profitability generated each year. Next, we find the average book value of the investment, typically by averaging the beginning and ending book values. Once we have these numbers, we apply the formula to get the ARR. The decision rule here is straightforward. If the ARR is higher than the required rate of return, then the project is considered acceptable. This approach focuses on accounting profits and the investment's book value, making it a practical tool for capital budgeting and cost analysis. Here we're comparing all 5 methods we've discussed for evaluating investment projects. First up is the net present value, or NPV method. This one does consider the time value of money, which is a big advantage. It has moderate simplicity, meaning it's not too complex, but you do need to estimate a discount rate. The decision rule is straightforward: accept the project if the NPV is greater than 0. The main drawback is that it requires an accurate discount rate estimate, which can sometimes be tricky. Next, the internal rate of return, or IRR, also accounts for the time value of money and has a similar level of simplicity. You accept a project if the IRR exceeds the required rate of return. However, the IRR method can be misleading, especially with unconventional cash flows or when you get ranking conflicts between projects. Then, there's the payback method. It doesn't consider the time value of money, but it's very simple to use. The decision rule is to accept if the payback period is within a target period. Its biggest drawback is that it ignores both the time value of money and any cash flows that occur after the payback period. We also have the discounted payback method, which improves on the payback by considering the time value of money. It also has moderate simplicity. You accept the project if the discounted payback period meets the target. Still, it ignores cash flows that happen after the cutoff date. Finally, the average accounting rate of return, or ARR, does not factor in the time value of money and is quite simple to use. You accept a project if the ARR exceeds a benchmark rate. But its major downside is that it uses accounting income rather than actual cash flows, which might not fully reflect the financial reality. Overall, understanding the strengths and weaknesses of these methods helps us make more informed capital budgeting decisions. When identifying relevant cash flows for a project, the main focus should be on cash flows that actually change because the project is accepted. In other words, we only consider future cash flows that differ depending on whether we take the project or not. These are called incremental cash flows, and they include both inflows and outflows directly associated with the decision. It's important to include opportunity costs, which represent the benefits we forego by using resources on this project instead of another. Also, any changes in working capital and the terminal cash flows at the end of the project's life are relevant and must be factored in. On the other hand, we exclude cash flows that won't be affected by our decision. This means sunk costs, which are expenses already incurred and cannot be recovered, should be ignored. Similarly, allocated overhead costs that don't actually increase cash spending because of the project don't count. Lastly, non-cash accounting items, like depreciation, are excluded since they don't impact cash flow directly. So, the key is to isolate the actual cash impact of the project from other unrelated or unavoidable costs. This careful distinction ensures more accurate capital budgeting and cost analysis. When evaluating a project, it's crucial to focus only on cash flows that are relevant to the decision. Relevant cash flows are those future inflows and outflows that will actually change if we accept the project. For example, the initial investment includes costs like purchasing equipment, installation, training, and any working capital that needs to be tied up at the start. Then we have incremental operating cash flows, which cover additional revenues, cost savings, or any extra expenses directly related to operating the project throughout its life. At the end of the project, the salvage value represents the cash we can recover from selling or disposing of the asset. On the other hand, irrelevant cash flows do not affect the decision. These include sunk costs, which are past expenses like research or design costs that we've already incurred and cannot recover. Depreciation itself is also irrelevant here, it's just a non-cash accounting charge and doesn't impact actual cash flow. Finally, allocated overhead or fixed corporate costs should be excluded unless the project causes these costs to increase. So, the key takeaway is to include only those cash flows that will be directly influenced by the project decision to ensure accurate capital budgeting and cost analysis. Here on slide 19, we're focusing on some of the real challenges that come up in capital budgeting practice. One key lesson is that even the strongest models can fall short when the assumptions about the real world are weak or unrealistic. It's crucial to carefully estimate cash flows, because inaccuracies here can lead to flawed decisions. We also need to be thoughtful when choosing discount rates, as they directly impact the present value calculations. Accounting for inflation is another important factor, since ignoring it can distort cost and benefit projections over time. Assessing risk realistically helps us better understand potential outcomes rather than assuming overly optimistic scenarios. Lastly, managing bias and incentives in the decision-making process is vital to maintain objectivity and avoid skewed results. Together, these challenges highlight why capital budgeting requires both rigorous analysis and practical judgment. Once a project is approved and underway, it's crucial to conduct post-implementation audits and performance evaluations. This means we review the project by comparing actual cash flows, timing, and returns against what was originally forecasted. Doing so helps us uncover any forecasting errors, hold teams accountable, and ultimately make better capital budgeting decisions in the future. The key steps in this audit process include comparing real outcomes with our initial projections, identifying the reasons behind significant differences, and examining how the project was executed along with the assumptions we made. We also look at any follow-up actions that took place. The insights gained from these reviews are very valuable. They allow us to refine our forecasting models and investment assumptions, so we improve our predictions going forward. Additionally, these results help us evaluate managerial performance more fairly by seeing how closely actual outcomes align with expectations. Finally, this process strengthens how we screen and select future projects, ensuring better decision-making and more successful investments. On this slide, we're discussing the important issue of managerial incentives and how they can sometimes lead to gaming the system in capital budgeting. First, it's key to recognize that projects might appear very attractive on paper, but that attractiveness can be misleading. Managers may intentionally shape forecasts to secure project approval, protect their budgets, or make short-term performance look better. One common problem is inflated projections. Managers might overstate expected revenues, cost savings, or residual values just to justify investing in a project they prefer. There's also a tendency toward short-term bias because bonus plans often reward quick paybacks rather than higher-value projects that pay off over the long run. Another factor is selective assumptions. Important costs like risk factors, maintenance, training, or implementation expenses might be downplayed or overlooked completely to make the project seem more favorable. To mitigate these challenges, it's crucial to implement independent reviews and conduct post-audits to compare forecasts with actual outcomes. Linking incentives to real project results rather than just forecasts helps encourage more honest and realistic assessments. This approach promotes better decision-making and ultimately more successful capital budgeting. When we talk about capital budgeting, it's important to remember that it's not just about picking projects that offer the best financial returns. The real strength of capital budgeting lies in selecting investments that align closely with the company's overall strategy. This means approving projects that do more than just boost profits. They should also help strengthen our market position, build critical capabilities, and support long-term competitive advantages. For example, we want to focus on expanding in areas where the company can grow faster or serve our customers better. This ensures we're not just growing for growth's sake, but in a way that truly adds value. At the same time, it's essential to fund assets that improve operational efficiency, enhance quality, or help differentiate our products and services from the competition. Finally, when making these investment decisions, we should choose options that protect our future cash flows and maintain strategic flexibility. This approach helps safeguard the company's financial health and adaptability in an ever-changing business environment. So, capital budgeting isn't just about numbers, it's fundamentally about supporting and advancing our strategic goals. What matters most in capital budgeting is maintaining a strong connection between financial analysis and strategic judgment. Using methods like NPV and IRR is essential, as they are the primary discounted cash flow techniques for determining if a long-term investment truly adds value. It's also crucial to accurately identify which cash inflows and outflows are relevant. Only future cash flows that vary between options should influence our decisions. While tools like payback period, discounted payback, and ARR can offer helpful perspectives, they generally play a secondary role compared to value-focused DCF analysis. Additionally, conducting post-implementation audits is important because managers need to compare the actual performance of a project against what was expected. Ultimately, capital budgeting decisions should align with the company's strategic goals rather than simply showing acceptable financial numbers on their own. These are the key takeaways to keep in mind. To sum up, making better investment decisions starts with a disciplined approach to analysis. Capital budgeting is essential because it helps managers focus on projects that create long-term value rather than just generating short-term activity. Moving forward, we will apply key techniques like net present value, internal rate of return, payback period, accounting rate of return, and relevant cash flow analysis to real decisions in Chapter 22. This will deepen our understanding of capital budgeting and cost analysis and how these tools guide effective financial management.